Howdy, Jacob here. Today we're looking at Illinois Tool Works in the machinery industry with 78 billion market cap, 83 billion enterprise value. Huge company, founded in 1912, based out of what? Illinois? Crazy. Um, Growth is very slow. 14.5 billion in 2014 to 16.1 billion in 2023, where when COVID hit, they actually got smashed, dropping $2 billion in revenue. But even with that, return on invested capital has always been very consistent. So they've been good at, although their revenue's been hit, keeping that earnings up. Gross margin up 2%, operating margin up 5% over the last 10 years. So beautiful to see that. Income statement shows about 25% of shares repurchased. So that's helping the investor. Hopefully they bought them at cheap shares, but it looks like they just dollar cost average again. That's not a bad thing to do if you're buying into a great business. You're essentially just gonna get the rate of return of the business. It's like dollar cost averaging into the S&P. You're gonna buy up sometimes, buy low sometimes, but in reality, you're gonna get the roughly 8 to 10% on average. Here is interesting because the growth isn't substantial. So for them to be buying back shares, I'd absolutely want them to be doing it when it's stupendously cheap, which, again, just not sure whether they're doing that or not. Balance sheet has $1 billion cash on hand and good amount of short-term debt here. $8 billion in short-term and long-term debt. That $8 billion is not super concerning in relation to their free cash flow. You're probably looking at 3.5 years of their 5-year average free cash flow to have in debt, which is not, again, not super concerning, but you got to realize that at some point that debt's going to be due, and obviously you can refinance it, but you're just going to have to figure out what to do there. So, cash flow side, I do like that. Capital expenditures have increased maybe 30%, while cash from operations has over doubled in the last 10 years. Love that. Use of cash is very heavy on the stock repurchases. I think that I balance out sometimes whether I like that or not, because again, their use of cash, you're investing into this company, and their use of cash should be the most advantageous for the investor. And so if you're going to buy back shares of stock and the company is only going to grow at 1% a year and they're already pretty frothy in price, you're not going to get a great return on that money. So you might have done a better job reinvesting back in yourself and getting these possible 26, 27, 23% rates of return. And then they do have a dividend that is paying 2%. And from a 5-year average free cash flow perspective, you're probably looking at 60-65% payout ratio, which is not super concerning for a company producing this much cash flow, but um, just an interesting use of cash given that their return on invested capital is so great. So let's look at making some assumptions here. I think we're going to be looking at essentially a so my assumption here is that they're going to grow pretty much in line with inflation. Maybe they'll make some acquisitions to grow a little bit more, but there might even be some slowing growth or even declining growth due to the fact that they're up a bit higher than what they were pre-COVID. Can they sustain it? Absolutely, but I'm going to be conservative. That's just who I am. And then on the PE side, yeah, they have a great return on invested capital. So if they do reinvest, they could get a massive return on that money. They don't reinvest from their historical figures. It looks like a very large amount goes towards just paying out as a dividend or repurchasing shares, which isn't giving me the best return on my money. So reinvesting and getting those 18 or 20% returns. So that's the reason for that. Margin side, let's go with pretty much the average here, 18, 17. Boom, might as well do that. Share change, let's buy back 1% of shares. Buying back 1% of shares is going to be using about 800 million. Okay, and then for the dividends, let's keep that the same. And then the rest, maybe 20 to 30%, hopefully they balance out between making acquisitions that are advantageous, reinvesting in yourself to get those massive 20+% rates of return, or paying down debt, which they do have a bit of. So I think I'm comfortable with these assumptions, and I get to a price point that needs to fall quite a bit. Again, it makes sense. Their PE right now is 26, and I'm saying it falls in half, and their growth rate is nowhere near outperforming the discount rate that I'm looking for. So keep that in mind when you do your own review. Hopefully you enjoy the video and have a fantastic rest of your day. Thank you.